So we reached the final session for today, and I'm very happy and excited to see so many people here. Our next panel is about liquidity. And liquidity is a landscape that never stops changing, providing endless opportunities for brokers and other industry participants. Our next panel, with a truly amazing lineup of specialists, will explore the latest trends and best practices in liquidity. I want to invite Mr. Ormoz Frayar, Global Head of Institutional Sales at Equity Group. Please.
So we only have 45 minutes, so I'm going to start very quickly, and I'm going to let you guys ask some questions at the end. I don't think we've never had some of these guys on the panel here before, so we got a true group of specialists when it comes to market making, price formation, very experienced. So I'm going to let them very briefly describe what they do at their companies and perhaps a little bit about their previous roles as well. So if I start with you, Ian.
Hi, Ian Daniels. I look after e-distribution at Nomura for Europe and the Americas. Previously, I was based at RBS NatWest for 20 years, looking after FX sales for the last 5-6 years. I think that the focus here is going to be on liquidity, good, bad, and must know. And you know, we've got some great speakers here, and I look forward to doing this. I think just a bit about Nomura. We're, as you may know, we're an Asia headquartered investment house, trying to sort of bridge the gap between East and West.
Japanese. Nice.
Okay, I'm Alexey Zheltsev. I'm co-founder of a data platform called TradeFeeder. Before that, I was a hedge fund trader for about 10 years. And before I worked in a number of basically consuming liquidity. So I had experience with liquidity on buy side. And before that, I worked in a number of investment banks. The last one was a bank called Lehman Brothers. Some people may remember that. And that's probably it.
Thank you. Andy?
Hi, so I'm Andy Biggs. I run liquidity at CFH, which is part of the Trade Tech Group. CFH offers multi-asset liquidity to retail brokers, small hedge funds. The Trade Tech Group has grown into a bit of a monster and offers a number of different products among technology, risk management, and liquidity. Previously, I've had the pleasure of being at a few different primes, including Sugden and IS Prime. So I've seen how it's done in a few different places and been able to use that, I think, at CFH to grow our product.
I'm Jeremy Smart. I run the distribution team at XTX Markets in London. We are I would say the leading non-bank market maker in the foreign exchange market. We're also a major market maker in equity markets, in commodities and futures globally. I've worked in FX industry since 1996, which is quite appalling to think about. But obviously seen a lot of changes during that time and worked previously at Deutsche, Morgan Stanley and RBS.
Great, thank you.
My name's Connor Daly. I run EFX sales for EMEA at Goldman Sachs, which incorporates distribution of liquidity and FX cash and options products, digital assets products, market data products, various different portfolio analytics tools, kind of broader range of tools. I've been doing that for 4 years. Prior to that, I was at Barcap doing a very similar thing without a beard for about 4 years as well.
Thank you. So I've written down some questions, and the first one, I felt like we wanted to know a little bit, since you guys are so experienced, the companies you represent, very experienced in this field. I want to go straight to the kind of money question. I want to know how much money you guys make.
Personally or institutionally?
Yeah, no, I want to know how much money do you make? Is there money in FX as before? Is there a lot of money in FX? Is it getting commoditized? Is it difficult to make money? Perhaps in certain currency pairs, certain aspects, you make good money if you are allowed to talk about it. Goldman Sachs.
Great, yeah.
So look, busy doing God's work.
Yeah, right, exactly. So look, we can talk about some public data figures available, right? So there are companies who are employed to actually evaluate the available wallet, so available money for sell-side institutions to make off this business. Companies like Greenwich, for example, Greenwich Market Associates put out loads of fantastic analysis on this. In the last year, the FIC wallet for global counterparties contracted 7%. That's just a fact. You can chart that back. It's been a fairly secular trend for the past kind of 6-7 years, which should give you some estimation for the challenges that the sell side face on this. I think that for Goldman Sachs, this is still a very attractive business to be in. You know, FX gross headcount across sales, trading, strats, technologists, everything like that has only grown every year for the past 10 years. It's still a business that we're investing in. Is it still the case that it's also a low and lower return business over the course of time? Yes, I would say so.
How many people in FX and FX department globally?
Globally, that's a good question. Probably about 600.
600. And so the numbers are public, how much you guys made in spot FX or FX?
So the corporate comms disclosures, I think, go down to a granularity around FIC, something like that.
Including fixed income, currencies. Okay, so how much is
yeah, no, so it doesn't have a breakdown below that.
Okay.
It doesn't have a breakdown below that.
That's not public, is it, the FIC numbers?
The FIC figure, I think, is in our results, actually, yeah. But nothing below that.
How much was that in?
I actually don't have that figure to hand. No.
All right, cool. XTX, maybe? Not public.
Well, obviously, you know, look, I'm not going to disclose the actual, the exact, what the gross profit of the business is. It's a profitable business. However, what I would say is there is a huge discrepancy or difference between, say, euro-dollar market making, dollar-yen market making, and NDFs, exotic EM currencies, et cetera, and there's a very different return profile in all of those currencies. But if you simply just do a bit of unit maths, this will give you an idea of kind of what you're looking at. You know, most banks and sort of top or leading non-banks like ourselves in EFX spot are probably making a price of 0.2 in 1 million euro-dollar. So if you think about that and you boil that down to spread, that's somewhere around $11 of spread, something like that. So best will in the world, mid to, you know, in terms of mid to bid or mid to offer spread, that's about $11, right? So best will in the world, best I can probably ever do from that is, you know, retain about 50% of that. So that's about $5.50. Then I've got to pay PB fees on top of that, and then I've got to pay platform brokerage. So, you know, you can do the maths. It's not a lot of money for transacting. That means that you have to transact in huge amounts. You have to transact at very large volumes in order to really be able to participate in the market, particularly at a time when the costs of the industry are going up. The costs from a technology point of view to participate in the market are going higher. The speed of market data is ever increasing. You know, I think the CME and EBS will take market data to real time before, you know, within the next year or 2 years, from the 5 milliseconds that it is today. Reuters are going to come down significantly. The market data costs themselves are very significant. You know, EBS Ultra, I think, is pretty public. It's like 50 grand a month for that. That's just one of your market data feeds. So, you know, once you start plugging in all of these costs, it's very obvious that it's an extremely low margin business. So you have to do huge volumes. And that's why you've seen quite a lot of people dropping out of the market, because overall market volumes contract. You know, there's a huge squeeze on margins. You get less players in the industry.
Do you guys publish any numbers? Volumes, anything?
We state volumes publicly. So volumes overall in FX, and obviously they do vary. So these are average daily volumes. Average daily volume in FX is around $60 billion a day, around 60 yards a day.
60 yards a day.
Yeah,
okay. And
we're about 200 yards overall across all instruments, I think, something like that. I don't know that exact number off the top of my head. But.
Okay. Andy, you guys are...
So I guess we have a different model, really, to these guys. You know, we are a brokerage, so for us it's a volume game. The more volume we do, the more money we make. It's as simple as that. With a slight nuance to that, where certainly in the institutional space, we can't just do as much volume as possible. We have to be careful about what volume we're actually bringing on to not damage the franchise and have a short bump in volume and profitability, but a medium-term drought in the quality of our core pricing. So for us, absolutely a volume game, but we have to be careful with where we're actually going and trying to find that volume from.
Okay, and again, there's no numbers out there publicly, how much volumes or profits, corporate level?
There should be CFH numbers, I imagine, out there publicly somewhere. I don't have them on me, and I don't know off the top of my head. And
Okay.
I think with the merger with the Trade Tech Group, it probably gets rolled up into sort of one large number now.
Okay. Ian, Japanese banks and all the Japanese brokers, the biggest on the planet, interact with you guys.
Yeah, I mean, I think I concur with some of the things that have been said, and again, before you ask, no, I don't know the number. So we'll start there.
Do you know any number?
No, I know nothing, as they say. But no, I think the key thing is some of the things in terms of commoditization. Yes, it is hard to make money. It's a utility. It requires significant and constant investment, and that investment is when I say significant. Jeremy mentioned some of the numbers, but then it's constant and it's constantly evolving, constantly trying to get quicker. There's a lot that goes into this, and you've got to decide whether you want to do it, right? And hence people have come out of this market because of that investment. Now, players like us, slightly smaller, should we say, than some of the larger commercial banks. We have things that we feel we can do better, and things like, as Jeremy alluded to, NDFs, structured products, things like that, and where there's a little bit more, I guess, meat on the bone in terms of NDF, in terms of spread. That market is becoming more electronified, and I think that's something we're going to, continue to invest in and work on. As you will see, we may talk about it later in terms of banks are investing more and more in their algo businesses because, there's a significant cost, but the algo business is good, clean fee income, and it's easy to see your cost against what money you make a lot more easily.
Okay. Before you ask, equity group, how much we make? I can't say the number either. We make good amount of money in FX, yeah.
It's the business
Can I add
we
something?
Yeah, so, you analyze, you must know the numbers.
I'm not going to comment on that, but what I want to say is that speaking about public kind of numbers, there was a heavily publicized ECB paper, which doesn't get more public than this. And what we're talking about is some people actually do pay $5 per million in euro-dollar. Some people pay 10. Some people pay 300. And these are the people you're probably talking about, Hormuz.
300. Never heard of 300.
No, these are public numbers from ECB. So it just shows that people who don't look at the transaction cost, they obviously see that those numbers can be quite big. That's the first thing about just kind of how much people pay in the market. Obviously, if we're talking about institutional market, it's a pretty tough market because it was kind of aggregated a long time ago, and it's extremely competitive, and it's probably, speaking from the numbers that Jeremy quoted, it's pretty much, it's not race to zero, it's pretty much running at zero, even though people with good technology and good risk management tools effectively make money, but they make money not because they overcharge, but because they deserve it. And the second point that Ian mentioned is about algos. That's just people are innovative. If they don't make money in one product, they go up the stream. They create something else. And this is a service as a service which is for clients. You can charge more because you're creating real service for people.
Yeah, this is execution algos you're talking about, which is you create a product that people can use to execute instead of just one click. Because algos, in this space, there is a lot of other algos.
Exactly.
Execution algos. Okay. Before I move along, any other comments? Did anyone remember any numbers or nothing? No? Okay. So let's move on to a technical question. Let's address some descriptions, jargon around aggressive flow. Maybe Alexei, if you could define it. How do people detect aggressive flow? How do they action it? How do you prevent it? What's aggressive flow in the trade feeder world?
Well, I guess it's not just a trade feeder world. Is in everybody's world. Aggressive flow is something you cannot make money from. It's pretty clear. It's a good definition, and I think it also implies that what is aggressive flow for one person is not aggressive flow for another person. We are talking about straight away, some clients are good for certain liquidity providers and not good for others. It's obviously an age-old question is, can you handle my flow? And it can be yes, and can be no. It can depend on your kind of skill set and your trading ability. One interesting thing about aggressive flow is that if you trade with counterparty and somehow it was extremely nice flow to have, and at some point you suddenly figure out that you cannot handle it anymore, maybe your head trader actually moved there, and it's called incompatible alpha. So they're using the same alpha model as you're using, so potentially there is a brain drain, and your guy basically ended up implementing his alpha model and running the same alpha model in a different organization. But if you want a definition, we obviously come up with all sorts of exact statistics, which is basically what is happening around the trade, what is happening before the trade, what is happening after the trade, and how you classify. Again, in numbers, if you make, I don't know, $15 per million, if after 1 second, half of this amount disappears, then this is probably aggressive flow because you cannot hedge it. You have to dump it into the market, which effectively doesn't kind of work for anyone, including the client.
Yeah, so Jeremy, there's a need for a common language as well on this.
No, it's a very good definition. The way we view it is we look at everything in terms of, what the markouts of trades look like. So we look at the price we got the trade, and then we look at what happens to the market, the primary market as we view it, over the next, actually we look at an hour, but obviously for you guys, you won't think that an hour is necessarily particularly relevant. But we look at an hour just to look at the whole profile. But really, we're focused in on the time inside, let's say, 5 minutes, right? And for some clients, that flow goes through 0, if you like, on the markout within, let's say, a minute, 2 minutes. I don't necessarily view that as especially aggressive, but it's certainly not soft either. And some flow goes through 0 in 50 milliseconds. Right? And I'm not quite sure how you're supposed to make money out of flow that goes through 0 in 50 milliseconds, or that anyone can do that. And, some people definitely seem to have a vision that XTX in particular is able to turn water into wine. All I can say is we can only turn it into Rob Malin's wine, which is really probably not a great definition. Sorry, a bit of an in-joke there.
It comes out of the box.
Yeah,
for
it comes
everyone
out
who
of the
doesn't
box.
know that.
Yeah. But we look at it in those terms, and just very honestly, we look at it and we say, does it look kind of like a green ski slope that you see on your ski map? Does it look like a blue one, a red one, or a black one, right? And if it looks like a black one, it's probably pretty bad and pretty hard to handle. And all that means is the only defense mechanism that you have left is to increase the inception spread. So the more aggressive flow is, the worse price it will attract over time. And that's why we focus so much on the analysis and the data analysis, and when we work with our clients to look at individual tags, because individual tags have very different profiles and have very different performance characteristics. And one thing that exists in our market, the same as in any market, is your feed and your pricing will only be as good as the lowest common denominator of the worst flow that comes down the pipe, right? And that's why increasingly we look at, splitting feeds, having more feeds, giving different clients different prices, et cetera, and specializing all of that. And that's why we need tools, independent tools, to look at that. And the last thing I'll say before I hand over to the rest of the guys is, it's not always the actual underlying nature of the flow that causes it to be aggressive. Sometimes it's the other people in the liquidity pool. So sometimes it's the other LPs. So you can have perfectly decent flow, but if you've got 5 guys round the table and they're all receiving $1 million of a $5 million sweep, for example, and the market immediately moves very, very quickly, sometimes that's got nothing to do with the original $5 million clip and everything to do with one of those LPs who immediately goes and smashes the primary market, right? And spoils the entire party for the other 4 LPs. And guess what? That LP is probably, by the metrics that a lot of people choose, the best LP. He's probably got the highest deal acceptance rate, the tightest spreads, right? And the fastest response time. Right? He also happens to be the one that goes and destroys the market for everyone else first up. So that's why you need tools like TradeFeeder to help you analyze the portfolio.
Yeah, completely echo those thoughts. XTX and Goldman were 2 of the kind of early movers supporting the TradeFeeder product for exactly the problem that Jeremy describes very well, which is that it's very difficult. I can imagine, running a broker-dealer, running a sell-side institution, a buy-side institution even, where optically, if the only statistic that you're looking at is the market share, and that top provider has been my top counterparty for X months, X years, you are potentially disadvantaging all of your clients. You're potentially putting at risk sell-side relationships which you will need to rely on when that top provider, quote unquote, has to step back. Actually, often I think that one of the problems that we see and we come up against other sell-side market makers who aren't as responsible around their risk management practices tends to be a human one. I think the mark-out analysis approach is fairly standardized now, which is why a product like TradeFeeder will be adopted very quickly, I suspect. The problem tends to be a human one, which is that often the trading desks have salespeople whose incentivization structures within those businesses are misaligned with the aims of those trading books. You have traders running books trying to risk manage flow effectively, and salespeople who are compensated on volume metrics only, regardless of the quality of the flow that they bring in. Until that you actually kind of break that and align the incentives, this is a problem for the sell side, to be clear, but it's a problem that the buy side and everyone in this room can help with as well. Until you have those conversations with your salespeople, make sure that they're aligned with their heads of trading. You have no guarantee that any of these relationships will last through distressed liquidity events over the long course of time.
So analyzing, you guys joined TradeFeeder because you wanted to use the same product, or you could build your own ones?
We think, so we can build our own ones. We both have, very similar GUI tools that do the same thing. The problem is that if you're running a buy-side institution, it's very difficult for you to do this. It costs a lot of money to do it. And actually, we think that the sort of independent third-party angle and the ability for everyone to come together on a common interface, speak the same language, has value in and of itself.
And I think that's key. I think one analogy I had is like if you're going into your year-end or mid-year performance review, having data to look at and analyse, and the same data gives you a much better conversation, right? And I think that's what we come to with some of these liquidity discussions. And I think one thing, I think people are starting to see that the market fragmentation and the more difficulty for liquidity providers is coming to the fore. We're having a lot of conversations now which we perhaps didn't have in the past with business managers at hedge funds who are actually caring about this stuff and worrying about all of their different PMs or execution desks and what they're doing, and then they have a guy, because for sell-side banks to have those conversations with 20 different people at one organisation can be difficult. So they say, right, let's bring it under a business management. These global hedge funds throughout all over the world, let's bring it under one person, and they can have that conversation and be the face-off with the sell-side institution. So I think that to me is a market shift. I think the tools like that we have, the third-party tools that are out there, are helping those and helping drive those discussions. And I think that needs to go all the way through to people in this room and various different types of sell-side institution, and have those discussions as well, because the liquidity is hard to come by, and there should be an understanding of how the market structure is and how it works.
We're doing it. So, Andy, before you, can you also explain the mark-out model, how, in a simple language, how you guys measure?
Sure.
When I trade 1 million, you measure for 5 minutes how it's performing.
Sure. So I guess we went the route of building our own analytics in-house, and we essentially rely on markouts. So with the markouts, we kind of want to try and model what we think the flow is worth to our liquidity providers. We understand they have different P&L models, and we're not going to get it right all the time, but the markout gives us a pretty good idea of what's going on. And the markout is simply the value of the trade versus mid, from inception through to 2 minutes, 3 minutes. We don't tend to go out to an hour. We tend to stick to sort of 2 minutes time. And we then, for each trade, can assign effectively a dollar value and then aggregate that up via client or currency pair or time zone, and really get an idea of what's going on. I think one of the points I want to make is I think lots of the flow from the guys in this room and at this conference is generally very, very good, and lots of the flow that looks aggressive. Normally, if you pick it up early enough, you can have conversations with the clients and figure out that maybe it's the execution's wrong or the liquidity is slightly wrong. and try and fix it that way. I don't think there's very much flow. There's not many black slopes. There's quite a few kind of blue slopes here.
Yeah, we have good flow.
It's yeah. So here's the thing, though, right? In the market, in the market that we exist in, how many real, genuine liquidity providers are there? Real, genuine LPs. I'm going to be generous and say there's 10, right? And there's probably quite a few people in this room who've got 20, right? Japanese retail guys, and I know this because they have to publish who all their LPs are, which is always quite funny, have 27. We've got some with 27, 29 liquidity providers. There just aren't 29 liquidity providers in the market.
Some people here wouldn't agree that they
So
would.
the point I'm making is that more is not always more. Sometimes less is more, and less is more in terms of focusing on the quality,
Yeah,
because the quality is really important.
It's true, but some people are taking risk, and that's market making. And it's more than 10 people out there. I think you're looking at it from an institutional level, maybe banks, non-banks, that kind of thing, maybe PB services. There are some big guys out there taking risk. They feel they're market makers. They have desks.
Sure, I'm talking about in the institutional market.
Yeah, so 10, roughly.
But I mean, I'm talking about, you know, for guys out here, the flow that they actually end up hedging, right? Not the stuff that they're, you know, booking, right? But the stuff that they actually end up hedging, that's the stuff that comes to us as institutional market makers. And once it gets to that point, there's probably a maximum of 10. So if you have 20 in your pool, the chances are there's a few wrong uns in there, in all likelihood.
Just want to add on this point that probably there's no magic number, but you have to know and you have to kind of manage it. One interesting, also I want to piggyback on Jeremy's point about the kind of toxicity or aggressiveness of your flow. If you have an aggressive flow and LP tells you have an aggressive flow and you don't know why, aggressive flow is like alpha. You cannot have it. Somebody else creates it for you. And you have to look at your LP stack and see who is creating this. It's very difficult to create short-term alpha unless, you know, you're trading with somebody who is making it up for you, effectively. And that's also a subtle point here because, and Jeremy kind of alluded to that, is that LP who is creating this alpha for you and making your flow look really bad is probably going to look fantastically well on all the reports. So if you have 10 LPs and you collect 10 reports, this LP will be the best. But this LP is actually a problem. I don't know if it's he or she, but it will be a problem.
Sorry, can I ask a question? So why do you use, typically, not banks, whatnot, use the same P&L horizons, so to speak, given what you just said there?
No, we don't all use the same horizons.
Typically, from the banks I've spoken to, from the liquidity management perspective, it's all done on the same time horizons. So, 100 milliseconds, 500 milliseconds, 1 second, 3 seconds, 50 seconds, up to a minute. Yeah?
Which company are you from?
I work with MFP Trading.
MFP Trading.
Yeah, so I deal with liquidity management and predominantly, I'll say 90% of the banks, in terms of the time horizons, in terms of P&L, they all use the same metrics.
Yeah, but that's a function of the available liquidity that, you know, everyone in the market with a similar credit profile can lean on. So the only reason in G10, you know, it's not made up or picked out of the air. The reason for G10 spot FX, for G3 spot, you know, let's say your example, you buy €1 for me, something like that. Actually, I'm more interested in the markouts, let's say, like nowhere longer than 30 seconds, probably not longer than 10 seconds, actually, just because we've got such a large liquid book, so much turnover, that flow just is...
The bigger, the longer you look, or?
Well, the less liquid, the longer that we look. So we have an NDF book, for example, which has a multi-day hedging mandate. Now, I'm not saying that there's any kind of value in looking at the markouts over a longer period, but it's reasonable that all of your liquidity providers operating in that marketplace with the same interbank access to other liquidity would look at the same market horizon because they're being put into the same risk and they have the same liquidity access to try and hedge it. So that shouldn't be, you know, a surprise necessarily.
Yeah, exactly. So how would you... I see you guys up in knowledge together. So right, you've got non-market makers, yeah? But you know, market makers who in essence isn't a bank, the bank entity, right?
Yeah.
You've got you guys. You two knowledge together. So how do you... In essence, you two are competitors in one way or another, yeah?
Yeah.
So you two knowledge together. How
Ooh.
That's going to be an interesting question.
I think it's a really complex question. We can definitely take it afterwards. I would say it's not a zero-sum market. There's room for multiple providers in this space to deliver high-quality liquidity to all investors who want to trade.
The liquidity in the primary market is not necessarily reflective of the liquidity that I showed to you. For example, I mean, we don't price you per se, but if we did, chances are I'd be ending up pricing you at 0.2 in euro-dollar, but the primary market's 0.5, right? So if I price you and I hedge it on the primary market, I get a loss every single time, right? So it's about your ability to actually, hold that flow and internalize it and offset it against your other business, and to be able to skew your price to the rest of your clients and the rest of the market generally in a way that doesn't leak that information. And there's a lot of science in that. Fundamentally, by the way, there is a big difference between us in terms of price construction and how we actually construct prices. And XTX is quite different in that to a lot of banks. We take a much more cross-asset correlation approach towards pricing, and so we have alpha built into the price. And in fact, we spend a lot of time working with our clients to ensure that that alpha doesn't get leaked out into the market to people who then use it against us in primary markets. So, the answer to the question is actually my time horizon is probably quite different to Connor's. My time horizon in euro-dollar is much longer than 10 seconds, for example. I would say in general, our holding periods across G10, and these are averages, somewhere around 5 to 6 minutes, right? And in euro-dollar, clearly less. In euro-stocky, clearly quite a lot longer, right? In EM, it's like 25 minutes, averages, right? And we publish these. So actually, we are looking to be very soft, very passive, hold the risk, and try to capture the spread. But remember how much spread I said there was in the euro-dollar trade up front, right? Not a lot is the answer. So the profile only has to change by a relative fraction for that return to disappear. I don't want to take us down too much of a detailed. I'm happy to have the conversation later.
Yeah. Did you want to add to this?
No, not at this point,
Okay,
I think.
Alexi?
No, I think what I said about alpha is probably still stands, is that certain LP can handle certain flow. And alpha is very different, as Jeremy alluded. Some people have different alphas and different book composition. That's about it.
To that, yeah, I'd agree. I think that's the key thing to think. Yes, there'll be, as we suggested, everyone has a similar look into the market, but everyone has, the whole point is people do things differently. And as alluded to earlier, what good flow, as I've seen coming from one place to another, good flow for one bank is bad flow for someone else, and there's a price for everyone. But that price will be different. There will be a different price per sell-side institution, and I'm sure there are some banks who get some sell-side who get great prices from everyone, and that's great. But there'll be other people who are on the margin. One of us can handle it, one of us can't, and that's just the fact of life.
So Andy, the need for a common language becomes quite important then, right? Or is that something you feel is needed in the market, or how everyone should look at this or analyze this, or should it be so different?
I think it's on the institutional space fairly important that everyone's speaking roughly the same language. And because everyone's speaking the same language, then you can find the differences amongst what people are talking about. So I think if you have that common understanding, it allows you to pick out more easily the differences between everyone up on the stage.
Yeah. So I quickly want to move on to something else. How has regulation changed how execution is done on your side recently? Something stopping you from doing certain things, hedging before you accept trades, or certain things that has changed recently? And also, perhaps there should be, if there has been, there should be on the buy side as well, some rules, what they can do and cannot do.
Well, obviously the biggest change in regulation in spot foreign exchange has been the introduction of the global code, which I appreciate is not strictly regulation, but it's an expected statement of kind of best practice. And actually the FCA is fairly clear that if you're captured by the SMCR regime, the senior managers certification regime, then they expect market participants who are subject to that to consider the code as best practice and to comply with it. The biggest single change in the code has been that I think is relevant in this space is around pre-hedging, last look, et cetera, et cetera. we have a very particular view on this, which is that the code effectively says that pre-hedging or last look, if you like, and let's just be clear about what last look is. Last look is an additional holding time from the time that you receive the transaction before determining whether or not you accept or reject it. Not the time from when you issued the price, the time from when you got the transaction back into your own books, right? And what you can do or should not do during that time period, and what you should and should or not do with order information should you reject that order. So our viewpoint is that the code makes pre-hedging essentially not illegal, because it isn't law, but essentially outlaws pre-hedging during the last look window. I appreciate there's some nuances around that and so on and so forth. As a firm, we operate on a policy of what we call zero hold time. That means for all disclosed relationships where we know who the client is, we give an instantaneous or near as instantaneous as we can acceptance or rejection message back to the client. So usually 30 to 40 microseconds before that information goes back. That gives the clients a pretty clear understanding that we are not using their information in any nefarious way. And the key point here, and this is really, really important, is here's what's happening with last look, right? Where someone's pre-hedging or has the potential to pre-hedge in the last look window. If I'm operating on a zero hold time basis, I'm making you a spot FX price, right? And that's exactly what you would understand. If I'm pricing you using last look and I'm holding your period for a significant length, any significant length of time, you're making me options prices, right? By the way, free of premium, right? And if you take something like last look to its logical extreme, I can price you choice all day long. You know why? Because I only stand behind the transactions that I want to, right? I'll have that one, don't like that one, have that one, don't like that, don't like that. And that's a completely different form of liquidity provision. So that's why we would like to see the next iteration of the code actually make very clear that the use of last look cannot be used for any kind of commercial practices. It should be used only as a single risk check immediately when the trade comes back. Check it's on market, check it for credit, move on, accept or reject.
Ian, do you guys, the rules, these changes, other changes that impacted you guys, maybe out of Japan?
Well, I mean, I think we look globally. I don't think we should decouple Japan from it. To be honest, I think it should be on a global and us as a firm. And I
London.
Think, yeah, but no, looking at us as a firm, I agree. It shouldn't be in that window. We do have a hold time, but within that window, we do not act. And I agree that we should not. Anything shouldn't happen in that time. But I think we should also focus on market participants in general and what people are doing, and client participants, technology providers, all the other people who should be signing up to the code. We've noticed there has been a sign up of quite a number of corporates to the global code in recent times, and I think that we were talking to a couple of perhaps some of the institutional brokers who are here, and they're starting to look at this and say, hang on, this type of thing is the type of thing we like too. So, yes, it's a code of conduct, but there's no reason why everyone shouldn't sign up for it. The market, to come towards a fair marketplace. So I think it's something that we should all look at, and it should be something that's used and adhered to within all the participants within this room.
Connor, do you feel the regulations tightened things up?
So I hope it will tighten things up. For us, very little change in our business. We signed the FX Global Code. We made the disclosures around existing practices, which are unchanged before and afterwards. It's how we've always market made. So it made very little impact for us, but we hope that it continues to add transparency, continues to put pressure on liquidity providers who are not as responsible in their provision.
And you guys are.
I think one of the points I wanted to mention was it's, I think it's important for people to sign up to the FX Global Code, but it's also then important for, some of the smaller guys not to sign up to it and then disclosure it away. So yes, they've signed up to it, but then they send you a disclosure notice that effectively null and voids. So I think that's something that certainly people in this room should just watch out for.
I couldn't agree more with that. I mean, disclosures are designed as a way to explain your trading practices to your clients, not a legal disclaimer.
I think what I want to add on FX code, first of all, is that the document is 50 pages long, or even more. So it probably tells you that there's a bit less common language that we'd like to portray. There's still a lot of disagreement about what is good liquidity and what is bad liquidity. It's not rocket science, but to measure the same thing and to actually agree on the exact number is a big deal. And second, on last look, since we're talking about this feature of liquidity provision in FX markets, we, from an kind of data company perspective, we're not prescriptive. What we are basically saying again, as was alluded here, this is you're giving an option to your liquidity provider, and you should understand you're giving an option. So it's like two consenting adults basically. If you're giving an option to your liquidity provider, make sure you're getting something back in return. And if you are confident that you are measuring it correctly and you are measuring your cost of rejections correctly, then and you are happy with this scenario, then do it. If you don't, or if you don't have tools specifically, then it's absolute disaster in general because it's going to cost you considerably more than you think it's going to cost you.
Yeah, I mean, we do a calculation on last look because we don't use it. So we do a calculation on if we did use it, how much would it save us on those trades? So what would the P&L, the theoretical P&L be on all of the trades that we accepted, that we would have rejected had we had a last look of, say, 100 milliseconds? And the number is comfortably in the millions, several millions. So it gives you an idea of, if you think about that and you multiply that up across the street, across all of the LPs, that's a big number.
Yeah. Ian, did you want to add something to that? That's okay. So the next question for me is something that everyone talked about many years ago, moving FX to an exchange model. We talked about it 10 years ago, before Andy was born. So could that happen, an exchange model?
All right. Who's younger, Connor or Andy? I don't know.
I don't know. I thought it was.
We can take bets later.
Yeah.
Let's
How old
focus
are
on
you,
these
Connor?
subjects, shall we?
How old are you?
I'm not going to make you a two-way. We'll do it after.
I thought you were a market maker. Come on.
We're
can
not.
have a last look on it.
Yeah. So is it possible moving to an exchange model?
Well, there is an exchange. This is the CME, right? And the CME is one of the three major primary markets in the world. Arguably, it's becoming more important, and it's gaining traction as a primary market within the world of FX. My fundamental view, though, is that exchange trading doesn't suit a lot of the market participants within FX. So, in general, market structure, in my experience, market structure moves to whatever is the best form for all of the market participants, right? And whatever's the right commercial model for those market participants. And FX has enough market participants that that's not enforced by some sort of, cartel or oligopoly or whatever that forces the market structure to be one thing or another. So it's found its natural form, and I don't see any major reason for that to change. What I would say is, if we, as an industry, screw up big time again, and there's another massive scandal, et cetera, around FX, the next stop is definitely regulation, right? And regulation is almost certain to force a market structure on the industry, and that's highly likely to push exchange trading higher up the up the line.
Yeah, I mean, I think that perhaps notwithstanding another crash or whatever, a self-inflicted wound from any scandals, I think the market works pretty efficiently, and as we've alluded to at the beginning of it when we were talking in terms of cost of doing business, it's not something that banks or liquidity providers are really going to be wanting to do. The heavy cost of change, it's not something that we really want to do, and cash products, the spot products were excluded from MiFID. Maybe that was the chance to do it, but as Jeremy alluded to, if you think about the real end reason people do FX, the real corporates, the people who are doing real, I guess, for want of a better word, real business, they don't want business on exchange. They want to take delivery of a product at a time they don't want to take it at. So, if they want the forward contract to mature in 6 weeks, 2 days, then that's what they want, and they need it for a reason, right? And that is the true end market and the end participants here. So we've got to think about that, and that's often why, as well, you know, be it pension fund managers, etc. There's a lot of talk even in the forward space. You know, it's been quite a slow move to more of an exchange/cleared model for that exact reason, that people, you know, have various different times that they want delivery, and that.
It's efficient, but exchanges are growing. So, what do you think, Alexi? If exchanges would be growing rapidly more, does that mean there's?
I think you shouldn't look at exchange trading as a promised land, obviously, because if you look at, you know, what is happening in equity world, you really, with the technology that most retail people, or especially even clients who have, they wouldn't want to trade on exchange, especially on the mess that, you know, US kind of equity market represents, because there are, it's not like exchanges don't reject. By the time you reach the price you want, it disappears, and the requirements are microseconds, not milliseconds anymore. So exchange trading on its own is not particularly, you know, especially if you have many competing exchanges, that's presumably what we want, because if we have one exchange, then suddenly people will start speaking, they're making too much money, or they're too monopolistic, even though there is an example from futures market, but generally equity market is extremely decentralized, and a lot of the same features that we observe, a lot of things like signaling risk, where, you know, you put in part of the big order and suddenly somebody jumps ahead of you. It's probably more pronounced than actually in OTC markets, in a way. And then it's interesting that you mentioned 10 years ago, because yes, 10 years ago, after financial crisis, obviously, after all these events of 2008, there was a summit in Pittsburgh of like big, you know, G20 kind of market policymakers, and they said by 2012, I think they said, which is like 7 years ago, all OTC products should be traded on exchange. And we're like 7 years later, we're still in the same situation. So I agree with Jeremy, actually, that it literally suits the market at this stage.
Connor, would you think exchanges would be bigger in 10 years? Would you expect them to be much bigger?
Potentially not in FX spot. There's certainly products, FX options, because the unclear margin rules, which come in later next year, will have a big impact on the market structure. I could see areas changing. For FX spot, no. I agree with Ian's point, which is that, you know, GS is where its clients want it to be, and they want broken dates. They have real cash flows in real corporate businesses that need to be administered and can't be done with exchange products. I think if you look at the parallel that Alexi raised is an interesting one in equities, which has kind of gone through that move to listed in a much higher percentage than FX cash products have. And actually, all of the time spent innovating in our execution services capabilities in equities is on things around what looks like OTC liquidity provision. You know, streaming blocks, being able to trade large size bilaterally off of exchange without that market footprint, right? That is what clients are interested in, and that is lessons learned from a market that deliberately accelerated its move to exchange more quickly. So I would be hesitant about you know, exchanges being the promised land.
Yeah. It's also important, though, that we shouldn't make exchanges necessarily synonymous with club trading. There are many exchanges out there that are not central limit order books. But if we did look at central limit order books, the reality is only something like euro-dollar and probably dollar-yen for about 16 hours of the day could realistically trade in any meaningful way on a club, right? Outside of that, spreads would be significantly wider, and there are some products just in no way suitable for club trading at all.
Yeah,
just not the depth of liquidity.
To add before we go on to the
questions? I just agree completely with that point. I think you know, for the retail, if it was to go on exchange, I think we'd see worse pricing.
Okay. We have time for 1 or 2 questions before we get kicked out to the pub. Any questions? There's a microphone as well. Raise your hands. I know you have questions.
Outside the 10 genuine liquidity makers, how are the others making money on regurgitating your liquidity?
Well, obviously you'd have to ask them that, Brendan. You know, I think that, look, the reality is there is a recycling of liquidity that goes on, and the way that works for you is if you are taking prices from a number of different liquidity providers, and then you're aggregating that into a top-of-book price. That price can be tighter than the individual price that any one of those LPs can actually sustain or show, right? And that gives you the ability to simply make a turn by aggregating all of that liquidity together. However, what that tends to do is create over-aggregation of the liquidity, because that liquidity comes into your book multiple times. So all of a sudden, instead of getting, one slice of a trade, I'm getting 3 slices of a trade when I only priced it for 1. And that doesn't work for me. But that might still work for the guy doing the recycling, though, right? And then it's up to me to take time to figure out this guy's just recycling. And of course, I do find that out eventually. But, our industry is like whack-a-mole, right? So, literally I will cut off the liquidity to one, leaking or recycling stream, and then it'll pop back up somewhere else. Right? And there is, our industry is so diverse in nature and so diverse in terms of the scale and number of market participants that is a sort of pretty much a daily job having someone manage that, right? Which is why we'd like to actually automate it, because I'd really rather not pay someone to do that all day long.
Do you think with that kind of common language and that the sort of commonality of analytics, recyclers are going to have a harder time?
Without a doubt, and it's already happened. I've seen them being squeezed out of the market, and now they come to me and say, we've changed our business model, we're a technology provider.